Bloomberg Radio.
All right, everybody, just coming up on about 18, 19 minutes to go until we wrap up the trade on this Tuesday. 24 hours from now, we will have had that Fed decision, know what the Fed is. And Charlie breaking it down, still up about 1/3% on the S&P 500. Good enough for another record close. And the NASDAQ 100 up about 0.8%. Remember, we're going to get a ton of big tech earnings after the close tomorrow and also on Thursday. No movement. Who's see?
It's a Fed Tuesday, Carol.
It is a Fed Tuesday.
Which means it's followed by a Fed Wednesday.
That's how it works. 2-day meetings.
Let's get into it with Danielle DiMartino. She's CEO and chief strategist at the research and analytics firm QI Research. She's also a former advisor at the Dallas Fed. She's here in our Bloomberg Interactive Broker studio. We've spoken to you a couple times in recent months. I want to go back to our conversation with you back in July. I remember it because you were kind of the first person, the gig workers out there and the people who were driving for Uber, for example, or Lyft, or doing other gig work, and the way that a lot of them, in your view, were overqualified because they couldn't find work in what they were trained for, what they went to college for. Is the labor market worse now than it was back in July?
Judging by my Lyft and Uber drivers, I would have to say yes. The demographics has expanded. And you've especially got a lot of kind of college graduates right now who are looking for gig work because they can't secure work in the broader economy as they thought they would be able to. You know, they walk across the stage proud with their diploma and boom, there's no work. So, I mean, right now, the unemployment rate among college graduates is the highest it's been since 1988. 1988, it was a supply issue because that was the peak of baby boomers entering the workforce. Now it's the flip side of it. It's a demand issue. And these kids are they're very anxious.
So when you've got Amazon letting go 14,000 jobs, a lot of it corporate, right? We've got UPS, and that's part of its cost cutting.
Matt Lazzetti at Deutsche Bank says, pay no attention to these headline figures because they're small in comparison to the churn that we see each and every month.
And that 5 million jobs are still being created. So what is the net
You
here?
look skeptical.
Yeah.
Well, I mean, we collaborate sometimes with Macro Edge, and they're an alternative to Challenger Grain Christmas.
Yeah.
And with the UPS announcement this morning, and of course that was so much higher than what was expected, right? It was 30% of what they had previously announced. So we learned from so many companies after the fact about attrition or layoffs rather than layoffs being announced. In any event, at 131,000 announced layoffs for the month of October thus far, and being in the heat of earnings season when so many companies are like, I'm going to get the stock to pop, I'm going to lay some people off. We're seeing the third highest level of announced layoffs in 2 years. So that, to me, at least, is alarming when you do what Chair Powell suggests you do. If you add the lack of hiring to the firing, because a few years ago, there wasn't all of this lack of hiring. Now it's very much a pervasive phenomenon in addition to the layoffs coming through.
Yeah, and then there was the hoarding that was still going on after the pandemic. People were freaked out. They couldn't find workers, right?
Absolutely.
Pandemic, post-pandemic. And so they're like, let me hold on to it. I mean, UPS is up 8%, and they're, you know.
UPS is flying. But look at the one-year chart.
Yeah, that's a good point.
Of UPS, and that required 48,000 layoffs in addition to the 34,000 they announced. There was another 14,000 in their corporate office. Amazon today said that's 14, but that's 14 of 30. And we know that
stock's down 30% in the past year. Well, UPS.
Yeah, UPS. Oh, yes, absolutely. So,
so then
got quite the yield.
All right, one word. How do you describe the economy? One word.
Weak.
So does the Fed obviously needs to cut, in your view?
I don't think the Fed has any. Yes, the Fed absolutely has to cut. I think that they begin to discuss, given the magnitude of the layoffs that are rolling in and the lack of hiring that Chair Powell said could in and of itself increase the unemployment rate. I think that right now what they're discussing is 25 or 50 in December.
So can I just throw at you, like Tim and I have had lots of conversations about earnings, right? Earnings growth is there. Revenue growth is there. So companies are doing well. Like that's the analysis that has come our way. And it's not just big tech, although we'll see what big tech has right this week because we get a big read. But it's been broader based.
I would say that earnings...
Do you not agree with that?
No. I would say that earnings are doing better than revenues. And so in one survey after another, whether it's a CEO survey, a CFO survey, a regional Fed survey.
But there is revenue growth that's, I think, coming in better. That's, again, what people
There is revenue growth, but remember, these are all based on lowered bars that are easier to get over. I mean, if you want to look at the entire revenue picture, I think it's important to bring in the BCY Go function and look at the bankruptcies that are coming in on top of this. And that is, S&P has been tracking monthly bankruptcies for forever. And last month, September, came in at the highest number in the post-pandemic era of bankruptcies. And we're seeing BCY Go is hopping. Whoever's in charge of that is busy.
So is we talk a lot about the K-shaped economy when it comes to consumers, but is it a K-shaped market where and we know this about the S&P 500 companies, that they're the Mag 7 have just carried this index for years.
Sure.
But are you seriously concerned about pretty much all the other companies?
Well, I mean, if you're asking me if I'm seriously concerned about the other 90% of Americans who are outside of the top 10% who represent 50% of spending, yes, I am.
Yeah.
And I think we're seeing that in freight.
But we're seeing it in freight, and we're seeing it in some companies, but we're not seeing it. I mean, we're at a new record for the S&P 500
we're
right
not
now.
seeing it in asset prices.
Why are we not seeing it in
stretch.
asset prices?
Well, there's something very automated about this market, and this market will continue to feed on itself because that is the structure of passive investing. Passive investing forces stock prices up because you have to buy the biggest market cap. Look at NVIDIA today. But that is a function not of necessarily enthusiasm about NVIDIA, the stock on a fundamental level, the way we used to think of portfolio management 101, but it is a function of passive investing flows.
So what do you tell investors? Do you just tell them, get ready? Or whatever to hit the fan kind of thing, or what?
According to Bloomberg, the cost of hedging against a decline in the markets is very expensive right now. So we know that. We know that portfolio managers are very nervous about what's happening. But no, I actually watch the Fed the most closely because you've got all of this money, trillions and trillions, I think $13 trillion in cash equivalents, money market funds, et cetera. That's predominantly owned by people who are 70 and older. So as long as the Fed does not cut too much, I think we're okay. But if the Fed starts to cut into what retirees consider to be the corpus of their monthly income, because they have really enjoyed the Fed being higher for longer, they've collected every single 50 basis point cut by the Fed, you take $71 billion of cash out of the hands of retirees. We don't want for people who own 40% of the stock market, i.e. the 70-year-olds, to even think about selling because that unleashes passive.
Okay, got to leave it there. Hey, thanks. Good to see you. Danielle DiMartino Booth, CEO, Chief Strategist at the research and analytics firm QI Research. Folks, we're counting down to the close. 10 minutes to go. This is Bloomberg.